Hey, this is Yoshi. I run a small investment firm that specializes in REIT investing, and in today's video I want to discuss my 3 favorite monthly dividend paying REITs to buy today. I just did some calculations and found out that these 3 REITs alone pay me roughly $1,000 of monthly dividend income, and I figured that now would be a good time to address this topic of passive income, given that I've been traveling for the last 3 months, and I think that would be a lot harder for me to travel like I am if I owned private real estate rather than REITs. A lot of investors like to associate the topic of passive income and financial independence with real estate, rental properties, but in reality, I think that private real estate is quite work intensive, and it's a bit of a myth that you can earn passive income from real estate. You always have some issues with your tenants, with tenants moving in and out, causing property damage, fighting with the neighbors or whatever. You have leaking roofs, clogged toilets, countless other potential issues, and so you keep getting calls from your tenants regarding whatever issue. Then you have to deal with them, getting contractors, figuring things out with your insurance company. Even if you delegate all of that to an external manager, then you have to manage the manager. The manager is going to call you when there are issues. So it's not passive by any means. I think it's very work intensive, and most investors underestimate the amount of work involved with rental properties. But with REITs, you have a professional management team handle everything for you in a very cost efficient way. And so even if you're traveling all year round, it really doesn't have any impact on you. You have complete freedom over your geography, your time. And so as an example, right now I'm on a cruise ship in the Caribbean, and I probably should have showed you this. I haven't done my bed. I'm sorry about that, but we keep rolling. So even if I will be cruising all year round, will have no impact on my monthly income coming from REITs. And today we're lucky because REITs are heavily undervalued. They've gone through a 3-year-long bear market, as I've often discussed on this YouTube channel. And as a result, dividend yields are historically high. You have a lot of monthly dividend paying REITs offering 6, 7, or even 8% dividend yields that are not only sustainable, but growing. And in today's video, I'm going to discuss 3 of the best monthly dividend REITs to buy for the rest of 2025. But before I get started, can you please do me a huge favor and click the like button and subscribe to your channel? Helps me a ton to keep on growing. Thank you so much in advance. So the first REIT I'm going to discuss is called Canadian Net REIT. This is a REIT that most people don't know because it's quite small in size. I've previously compared it a few times to Realty Income because it's a much bigger REIT in the same space. They are both what we call net lease REITs. They invest in triple net lease properties. These are typically service-oriented, single tenant, retail, but service-oriented properties like Taco Bell restaurants, 7-Eleven convenience stores, Dollar Tree, dollar stores, these type of things, Home Depot, home improvement stores. And we call them triple net properties because the leases are very favorable to the landlord. Typically, the lease term is very long at 15 to 20 years initially, and then include several 5-year extensions. The rents are increased every year automatically by 1 to 2%. And finally, all property expenses, including even the maintenance, is typically covered by the tenant. So it results in bond-like cash flow for the landlord. There's very little maintenance, and it can be very rewarding. The risk reward has been very attractive, and this is why Realty Income is very popular today. I think it's the most popular REIT in the world. It has managed to grow its dividend for 30 plus years in a row. It has earned very attractive total returns to its investors. But unfortunately, I think that Realty Income today is facing some issues I've discussed those on this channel. It's getting too big for its own good. This is forcing it to invest in new property types in which it's not an expert, so it's becoming a bit of a jack of all trades. This is increasing risks. The big size is slowing down its growth. And so I think that Canadian Net REIT is a better alternative. And in many ways, it's similar because it's a net lease REIT, but I think it's a more attractive investment opportunity because of 3 key reasons. The first reason, given that now we're talking about dividend income, it's offering a higher dividend yield with a lower payout ratio. Its current dividend yield is nearly 7%, and that's with a very low payout ratio of about 55%. And it's able to offer this high dividend yield with a low payout ratio simply because it's more heavily discounted than Realty Income. Today it's trading at about 8 times FFO, whereas Realty Income is at closer to 13 times FFO. And so the dividend yield of Realty Income is closer to 5.5%. So you're getting nearly 150 basis points of higher yield. And that's despite also having a lower payout ratio. The payout ratio of Realty Income is closer to 70%. So that's reason number 1. Reason number two, which is an even more important reason in my opinion, is that it offers much better growth potential over the long run, and that's because firstly, it has better internal growth prospects because most of its properties have shorter leases. This is a key advantage today because, one downside of the net lease property sector is that you're typically tied in these very long lease terms with limited rent hikes of 1 to 2% per year. And so you're not able to adjust your rents to when you're suffering high inflation like we did following the pandemic. But today, Canadian net lease REIT has much shorter lease terms, and so as these leases expire, expect significant rent bumps from them. This will result in faster internal growth. But on top of that, Canadian net REIT also enjoys better external growth, which is, when we refer to external growth in the REIT sector, this is typically referring to growth by raising capital and acquiring new properties. And to achieve that, you need to have a cost of capital that's inferior to the cap rates of the acquisitions that you're doing. Today, for most REITs, there's not much of a spread to be earned because their cost of capital is so high. But eventually, as interest rates return to lower levels, I expect both REITs to return to external growth. And I think that the Canadian net REIT will be able to grow a lot faster because historically it's been able to earn bigger spreads. And smaller size also allows it to enjoy greater accretion from each new acquisition. Because, if you're a $30 billion REIT, buying a new $5 million property is not going to have a big impact on your bottom line. But if your portfolio is only worth $300 million, it will have a much bigger impact. And so this is one other advantage of Canadian net REIT. And so historically, it's been able to grow far faster than Realty Income. I'll put a chart on the screen where you'll see its historic FFO per share growth and its dividend per share growth, and you'll see that it has been one of the best in the entire REIT sector. And this has resulted in very attractive total returns to its shareholders over the long run. Okay, so the first reason was that higher dividend yield for lower payout ratio. Second reason is faster growth rate. And the third reason is that it's operating in the Canadian market. And I think that the Canadian market today is more attractive than the American market for the net lease property sector. And the main reason for this is that the Canadian Central Bank has been a lot more aggressive at cutting interest rates. Their interest rates are today already about 100 basis points lower. And so I think that this is likely to drive more capital to the REIT market over the coming quarters, especially as the central bank is expected to keep cutting interest rates aggressively. And many economists expect the interest rates of Canada to drop as low as 2% sometime during the summer of this year. And so I think that this is a strong catalyst for the net lease REITs like Canadian net REIT. The Fed in the US is not quite as aggressive because it fears that all these tariffs could lead to higher inflation. And so this is a bit of a headwind for a REIT like Realty Income. And so ultimately, I think that this REIT is heavily discounted. It's trading at just 8 times FFO. Simply repricing the 12 times FFO would unlock 50% upside, and I think that these rate cuts could be the catalyst to achieve this upside. While you wait, you're earning a near 7% dividend yield, paid on a monthly basis and very safely covered with a 55% payout ratio. I've gotten the chance to talk to the company CEO quite a few times. We have a few exclusive interviews available at our REIT newsletter, High Yield Landlord. You can check it out with our 2-week free trial. I'll be the first link in the description of this video. But yeah, this is my biggest Canadian REIT investment today, and I expect to keep it that way over the coming years. Then the second REIT I'm going to discuss is called EPR Properties, ticker symbol EPR. This is a REIT that's more famous in the US. It's a net lease REIT that specializes in experiential properties like water parks, ski resorts, movie theaters, golf complexes, and so on. And today, this REIT is quite heavily discounted, and it's offering a 7% dividend yield, again paid on a monthly basis, safely covered with a 70% payout ratio. And I think that the valuation is low because investors fear that we might be headed into a recession, and these properties are perceived to rely more on discretionary spending. And so when we go into recession, typically that spending goes down, and so these businesses suffer. But what the market appears to be overlooking here is that EPR Properties, just like Canadian net REIT, is a triple net lease REIT, and so this means that its lease terms are very long, at over 10 years on average. I think its average remaining lease term is about 12 years. Its tenant enjoy a 2.2 times rent coverage ratio on average, which means that they could see their profits drop by 50% on average, and they will still be profitable enough to pay their rent check, so this leaves significant margin of safety. And so ultimately, I don't think that EPR would suffer much, if at all, if we go into an ordinary mild recession. It's of course different if you go into a pandemic or if you go into a great financial crisis, but in a regular, relatively mild recession, I wouldn't expect much impact on its rent collection. I think most of its tenants will be strong enough to survive a recession and keep paying their rent. The REIT has a strong investment grade rated balance sheet with relatively low debt, well staggered debt maturity, significant liquidity. It has guided to grow its FFO per share by about 3 to 4% in 2025, and so I think it's likely to also hike its dividend by about this much this year, given that its payout ratio is already in the low end of its targeted range. Just like in the case of Canadian Net REIT, I also think that there is some upside, given that it's trading at just about 10 times FFO. I think that the upside is not quite as strong as in the case of Canadian Net REIT, but this is a bigger REIT, it's an investment graded REIT, so there's not quite as much risk, you could argue, and yet you're still earning a 7% dividend yield while you wait, paid on a monthly basis. The upside will probably be closer to 30%, and the catalyst for it will be rate cuts, just like in the case of Canadian Net REIT and most other REITs. Okay, then the third monthly dividend paying REIT that I've been buying lately is called Gladstone Commercial, and I'm referring here to its Series O Preferred Shares to be more specific. I haven't bought its common equity, I'm buying its Series O Preferred Shares. And they're today offering a 7.5% dividend yield. They're trading at about 15 to 20% discount to its par value. And I think that they're very attractive because this REIT is a bit riskier in that it's a smaller REIT, it has a bit more leverage than average, it's externally managed, which is typically a red flag because external management structures can lead to conflict of interest. It's typically something that I tend to avoid. But in the case of the preferred equity, you have very significant margin of safety since you have that common equity buffer. Remember, the preferred equity is senior to the common equity, and so what this means is that for the common equity to even get a penny of dividend income, they need to pay the preferred dividend in full before that. And I think that this gives very significant margin of safety in this specific case because the common equity represents about 50% of the capital structure. So you have all of that as a buffer to protect you, and the assets are relatively resilient. These are mostly industrial properties that are released on a long-term basis with triple net leases, resulting in very consistent and predictable income. The management is very heavily invested in the common equity themselves, so they rely on the common dividend to earn income for themselves, which is a risk mitigator, I think, for the preferred equity holders, since they will be incentivized to pay the preferred equity so that they can earn common dividend as well. Again, here I've had the chance to talk to the management of the company. I think that Gladstone is one of the few external managers that's done a pretty good job at aligning the interests of the manager and the shareholders. So I'm not too worried about this conflict of interest in this specific case. And ultimately, as interest rates are cut down to lower levels, I expect more capital to rotate back to these preferred equity investments like the Series O preferred shares of Gladstone Commercial. And this could lead to another 20 to 30% upside as it reprices closer to the par value of $25 per share. And so again, now to recap, I discussed Canadian Net REIT, EPR Properties, Series O Preferred Shares of Gladstone Commercial. The average yield of these three REITs is about 7%, all paid on a monthly basis, and they each also could provide quite significant upside in the future as interest rates eventually return to lower levels. That's all I had for today. Let me know in the comment section below what other monthly dividend paying companies you're buying and what other REITs you would like me to cover next on this channel. Once more, if you could click the like button, that will help me a lot. And also one last thing, if I may promote my services a bit. If you want to access my full REIT portfolio, you can join High Yield Landlord, my REIT newsletter, for a 2-week free trial. It will be the first link in the description of this video. It will give you full access to my entire portfolio, all my REIT research, my CEO interviews, all my transactions in real time at no cost for the first 14 days. You won't be charged anything. You can cancel, no questions asked. You will only be charged if you remain beyond the first 14 days, and that's why we call it a risk-free free trial. Thank you very much. See you at my next one. Bye bye.